Russ, let's take stock, though, of where the economic mix is at the moment. Output data, the economy a little bit hotter than we thought it would be. Maybe shelter inflation a little bit stickier as well. When you look at that as a mix for the time being, is that bad for both stocks and bonds or better for one versus the other?
Well, I think it's better for stocks, is the short answer. I mean, obviously, yesterday was a tough number for the bond market. It reacted as you'd expect it to. Stocks took their cue from bonds. But, the flip side of this is we have an economy that, let's say we get 2.5% inflation in 2024, and we get another 2% growth, which might even be on the low side. If you've got 4.5% nominal GDP, there's a decent shot that earnings estimates are probably a bit too low, and we're actually going to beat that. So I think that despite yesterday's action in the stock market, it's probably going to be a decent year for U.S. equities. We can probably put another 6, 7, 8% on what we've already done year to date, and there's reason to stay long equities.
Well, this really raises a question of which equities, in particular, because some of the more cyclically exposed stocks, and I'm thinking particularly small caps, have gotten more and more beaten up the more people push back their expectations for rate cuts. When does that stop?
Well, I think it's why small caps are getting beat up. Last year you had this beta-driven rally in November and December after a tough late summer and fall, and small caps benefited. I think the problem for small caps right now, it's an odd point in the cycle to get long small caps. The quality is much lower than the large and the mega caps. And as we saw again yesterday, they are rate sensitive. So if we have an environment where rates are not falling as quickly as the market believed, small caps, early growth, these parts of the market are sensitive. So I think the short answer to your question is what we're doing, we're barbelling the portfolio. We're still long many of the mega cap tech names that are high in quality. We think benefit from long-term secular themes. And we're also long higher quality cyclicals. There's still a lot of parts of the market in airlines, in autos, and parts of the consumer sector and healthcare that are actually pretty cheap, despite the premium that the market trades at. Large parts of the market were left behind last year, and there is some value there.